Hey there, Chris Hobart here, the wealthologist. Now listen, the bond market and the Federal Reserve, they're kind of in a staring contest right now. And only one of them is going to blink. You know, the Fed says we're cruising into a soft landing, and the bond market, on the other hand, says we're heading into a pothole, and we better tap the brakes really fast and really hard. So who's right? Well, today we're going to unpack the economic tug of war we're seeing and why it matters more than ever for your portfolio and what smart investors are doing about it right now. Now, especially if you're worried about inflation and interest rates and tariffs and quite frankly, just everything going on right now, just trying to figure out where the heck this economy is going. Stay tuned. All right, let's start with what we know, okay? The Fed, who is our monetary policy quarterback, says it expects to cut rates twice this year. Now, they're projecting inflation to drop to 2.7% in 2025 and 2.2% in 2026. So basically, they're saying, hey, we got this. No panic here. Now, the bond market, not buying it. In fact, it's already pricing in 3 cuts this year. Now, inflation expectations, well, they've jumped. The 2-year break-even inflation rate, which is what the market expects inflation to be, spiked from 2.02% at the end of 2023 to 3.28% right now. I got to tell you, not a subtle move. That's flashing yellow lights at us on our economic dashboard. So what's really going on? Well, the Fed is managing the message, but the market is reacting to math. Message versus math. And that gap is growing. So let's think about and look at what the bond market is actually responding to. See, we've got weakening consumer confidence. We've got tariffs back in the headlines. We've got corporate profits under pressure, sticky inflation in housing and services, and global uncertainty that quite frankly just won't quit. If we put all this together, and the bond market says, yeah, we're going to need a little bit more support than the Fed is planning. So, let's look at the 10-year Treasury yield. It hit 4.81% early in the quarter. Then it dropped like a rock, failing to stay above that 4.34 resistance level and sliding down to around 4.1%. That's not noise. That's the market whispering something's off. So how are the smart investors responding? What are they doing? Well, first, they're not panicking. Instead, they're pivoting. They're not hiding in cash. They're making strategic moves with intention. Let me break it down for you. First, intermediate duration bonds. They're still solid, but they're less rate sensitive and they still offer income. But what about high yield bonds? Well, the spreads have widened, making income potential stronger. Yes, there's more risk, but also there's more potential reward as well. Now, some are asking about mortgage-backed securities. They're not flashy, but they're acting like shock absorbers right now. And what about senior loans? Well, floating rates and lower default risks are good. They're still looking strong while rates remain elevated. Now, preferred securities? Well, attractive yields if you avoid the landmines, like certain REITs or maybe regional banks that are out there. And finally, short duration municipal bonds. They're tax friendly, they're resilient, and they're well positioned if interest rate cuts do come quicker than expected. So the bottom line here is, durability is key, but so is flexibility. Here's my take. The Fed is trying to manage a narrative. What's the story going on? The bond market is calling out the blind spots. And quite frankly, as investors, we're stuck in the middle. Whether it's 2 cuts or 3 cuts, we still have volatility. We've got trade tensions and a lot of economic headwinds to navigate. And hoping the Fed nails timing, I got to tell you, that's not really a strategy, especially when your future is on the line. Now, that's when you need to reassess what you're holding, how you're allocated, and what income sources are working for you, and quite frankly, what's not working for you. So what does this mean for you? Quite frankly, I think it means opportunity. But really, if you're proactive, if you're sitting in, let's say long duration bonds or in low yield positions waiting for clarity, you may already be behind the curve. This is the time to get serious about strategy. And so here's what I want you to do. talk with a member of my team. We're going to sit down with you. We're going to take a close look at your portfolio, and we're going to help you reposition with purpose. Because reacting to the market is one thing, but getting ahead of it, well, that's where real wealth strategy begins. All right. I'm Chris Hobart, the Wealthologist. And your wealth, well, it deserves more than guesswork. So let's talk.